Hello, this is the week ending video, September 21st, 2012. The agenda slash order for what will be covered is as follows. Looking first at the gold daily chart. Moving further towards the gold to silver ratio, three different time frames of 44, 94, and 294-hour charts. The dollar index, it's a 104-day chart, which means from the duration going back to the 1970s, looking at the exact same chart, but adjusting it towards a method of inflation. And then taking a look at what 4.5% interest slash inflation really means, or really calculates, maybe might be a better word. And then finish it off within the paper rectangle of three different time frames, the daily, the 5-month, and the yearly chart. So without further ado, let's get started. We'll start within the gold daily time frame, which is extremely similar to the daily time frame on silver. And that is a pattern of higher lows and higher highs. It had this breakout from this key 1623 level, had no resistance at the 1685 and very little support, and it has just barely pierced below the previous high from earlier this year of 1791 on Friday, just about $1 or so underneath it. There has been several move ups like this, and each one of them has had mainly correction through time, although this one had a small price correction as well. And markets can correct either one of two measures. And those are the two measures. It has stayed well above this 18 average of moving averages. It has also managed to stay within the upper band, like a Bollinger Band, calculated a little bit differently, but using the same sort of theories for how it plays out. The Friday session had a hammer candle, which can be a little bearish. And well, it's not the most of bearish things. After all, if we take a direction of this and then match it up, the direction size of the move isn't that much. I can't drag it lower. Well, I guess I could if I do a copy. So it would be maybe, that didn't even work. Pretty much if that goes through, down to the bottom part of this range. Big deal, because it's not that big of a move. But then you have to say to yourself, okay, is this a good area to say that this is a bearish situation? At least just this one candle in itself. Are we at an area that could be support? And when you break resistance and you break above it, that level is now support, which is what I'm seeing. So I wouldn't put too much into this and say, yeah, this is looking bearish. If anything, I'm more on the bull camp moving forward. Now let's switch this off to the gold to silver ratio. We're going to start off with the 44-hour time frame. Now those are just odd numbers. Why would I use a 44-hour time frame? Well, it's because I want to do whatever's needed to use this low and this high, but it's also mainly the year-to-date chart as well. And at the start of the year, and the end of February anyway, that's when gold and silver topped. Silver hitting a top of 37.50, gold hitting a top of that 1791. And when gold and silver go up, this usually goes down. When silver and gold go down, or when they go up, this goes down. When gold and silver goes down, this goes up. So they went down. We've seen gold go down to about 1,500 and change, where silver went down, of course, to 26. But within this ratio, no support was found at this level in here, but resistance was found. Really, no support was found here, and again, resistance has been found again. And if you can't hold the second one, the second key Fibonacci, or 61.8% of a move from the 2 points, which is what this is, then that's a failed move. Now, it has to hold and stay below there for a decent amount of time, or have a decent plunge below. It hasn't had the decent plunge, but it has stayed below it for an okay amount of time, which is really stating to me that this does look like a failure and that you should have a test of this most previous low in at around 47 3/4. Now, let's take a look at this on the time frame of the 94-hour, which will take us back to the lows here of about 31. This is when silver was at about $50 an ounce, gold at about 1,500 and something. And then, of course, the major thrashing for silver brought this way up and managed to make it towards this top in here. Now, what's a little interesting is this little move here, which you might consider to be a Fibonacci fail, and I guess I would as well, because it didn't go down to this level that it was supposed to. Instead, it pierced decently above it, managed to go back higher. But now that this move that has managed to go higher is looking like a failed move, which we have seen on the 44-hour chart, does indicate that it's going to have further lower moves. So it should probably, again, have a test of this level. But even the 244-hour time, or 294-hour, excuse me, is very much very difficult to analyze because it's retraced 48.6%, or pretty much right in the middle of point A to point B. Now this point A is when silver was 8 and change an ounce, 8.5. Gold was a little under 700. And then this thing goes down to here where basically gold went higher. Gold went from 700 and pretty much did better than double, even though the ratio went lower, but silver did more than double. It basically went up like 5 times its amount, where gold went up a little more than 2. But since this has taken place, you have resistance at this level here, 61.8% Fibonacci retracement. And for the selling to be a failure, it needs to hold and stay above this line for a decent amount of time. That has not taken place. So therefore, in the middle of this range, there really isn't too much to state until you have a play above here or a play down below here for the most part. If, of course, you break above the upside and do something like go up and then boom like that, then, of course, you're going to be stating that this selling failed and the bull market's in play. Whereas, if, say, for example, you do something like this, well, now what I'll be stating is that this selling is, or this down move is legit, and the continuation of the pattern should do just that, continue. Okay, so that's the gold to silver ratio. Now let's take a look at the US dollar index. I'm going to take a look at the 104-day chart, which takes us back to the 1970s when this thing came into play. I've talked a lot about this, really the 80 level. That's not the line. The line for 80 would be approximately somewhere in here, and how it would be just dangerous if 80 is resistance and it breaks down the previous level of support, which is 70.7. This isn't looking good. This is extremely bearish, and considering that it has been consolidating like this in this choppy mess, it's ready to give very, very soon, and most likely will head down lower. Now what I've done is I've decided to adjust this exact same chart with inflation. Of course, I'm not going to go with any government inflation numbers or any alternate inflation numbers. I'm just going to use a base percentage to reduce it every period. So here we go. This is the inflation adjusted exact same chart. So we'll explain it, which is on the bottom of this screen. Every 2 days, 0.03617% is taken off the value to adjust for inflation. There are 10,400 total days, which totals a value loss of 6.6092 loss over the duration of 41 1/3 years, which calculates to a little under 4.5% inflation per year. It takes 100 years for 4.5% to lose 100 times its value. And that's the key, which is why I wanted to choose 4.5%. Because if we go back to 1913, that seems to me what it has lost is 100 times its value. The stock market's up about 100 times, a little more from that point. Gold's up about 100 times from that point. The currency has lost about 100 times its value then. And it's actually a little more than 10,400 days. It's closer to like 10,440, but whatever. I have to even this out when I do this chart. So a big, big loss on the currency. And the reason for this, why I show it, is the dollar index in itself is not the greatest of charts because it doesn't show the true complexity to the fiat currency because every currency that this is compared with is also that of the fiat currency. Okay, so with that being said, this is good for maybe determining that, using this as an indicator for gold and silver, other things, but not as an indicator for the loss of the currency. So let's take a look at what 4.5% really means. Let's just go over some numbers. Using compounded interests, compounded gains, however you want to look at it, 4.5% loss per year results in the following losses. Over 10 years, you would lose about 1.6 times the value. 25 years, a little over 3. 50 years, 10 times the value. So those who were around in the 1960s, is it fair to state that the prices have increased about 10 times? Look at the price of gas, look at the price of food that you buy at stores, and then determine from there. Moving on, 100 years, that's the 100, so that's why I use that percent. And I want to do a little under it, and well, it worked out fine. 200 years, about 10,000 times. 300 years, this number sign, this equal sign here, means almost or pretty much equal to a million. 400 years is 100 million, 500 years, 10 billion. And then say 1,000 years is 100 quintillion. 1,500 years is a nonillion. I don't even know if I pronounced that right. Those are numbers that we should not know, but if we continue living in this type of world, we're going to be forced to know. And after 5,000 years, that is a googol. If you want to know what a googol is, that's 1 followed by 100 zeros. Yeah, the currency is not doing so well. Because of that, we're going to take a look at the paper rectangle. This is the paper rectangle, which is that of a US $100 paper rectangle, priced in XAG, which is silver. This is another way of showing silver reversed, basically. And sometimes this is a good thing to do, especially if you're the type of technical analyst who can be good at picking one but not the other. So if you're good at finding bottoms or breakouts from bottoms, but not good at finding tops or breakdown from tops, then I really would highly suggest that you would reverse the charts, because if you're good at finding bottoms but not tops, then look at the reverse and that would do the trick for you. I'm going to say the same thing that I said with silver a couple months ago on the daily chart back then. For this thing to reverse over, there are multiple steps that need to play. First one is the break of a trend line. Is there a trend line that is still in play? Well, yeah, of course there is. So the first step is breaking that trend line. You also got to be concerned about the support area, because if support on a downtrend line breaks, that could mean massive, massive breaks to the downside. Of course, right now, it's nowhere near close to that, but if there's a plunge lower, something to look at. So the first one is the downtrend. Second one is this 18 average has to flatten out. That's the next step. Then after it flattens out, it has to start to go higher, and then you start to need to look at a pattern where it just goes down like this, something like this, so that the moving average would do something like that in that area there. So there's a lot of different patterns that need to take place. Let's move this out to the 5-month chart. This takes us back to the 1960s, 70s actually. 1970s. Why would you want to go long here by any means? Now, I've heard people say when it's down quite a bit that you don't want to be a seller. But question is it down quite a bit? It's already bounced from this level, and it's already been at this level before after it had a major, major correction. It retraced 61.8%. For this move to be a failed move, it needs to break and hold above this level for a decent amount of time. Now, that's a decent amount of time that it really played above it, but it really never did break above it, because you break above it here, then you go back to support. Okay, well, we're still at that area. Okay, maybe we'll break here. No, and then now we're back to the downtrend that it's in play. Now, what I want to talk about now is this, this upper band and lower band. Notice that when this thing was going up, that this upper band did not go in an uptrend. When you see that you come from a down move, it goes up like this, and this is either going sideways or down, then this is nothing more than a correctionary play. At least as of now, it has done nothing to make this an uptrend yet. Now, of course, it tried to do so here, but then it just stayed going sideways. Second thing with the bands, this works for both the upper and lower band, of course. When you reach the lower band, you have to ask yourself, is it really worth selling short or predicting it's going to go longer when you hit it? Well, you know what? Actually, I want to take a look at that on the next chart. On the yearly chart. So that's what we're going to do now. We're going to take this to the yearly chart, which is the final chart. And now let's take a look at this band. So back in here, you hit this band in here, and it just holds this, goes below it and above it. Back down below it, recaptures it to the upside, and then crash. Notice that pattern. Notice where we are now. It hits this band, moves up to here, all the way, and then back down below the band, back above the band, and now it's breaking below it. So would this be a time to say, oh, it's on the band, it is oversold, it really can't go lower? No, absolutely not. And because of the fact that you have such a large decline, you have your bounce higher, but it doesn't hold. And I'll tell you what I'd be saying here. As it was rallying here, I know exactly what I would say. It does not need to make a higher high. No, no, no. In fact, I'd be extremely surprised if it does. But what is important is to make a higher low, then break the previous high and start the pattern of higher highs and higher lows. So right in here was the key point. This is really where I would have needed to see it bottom, start to go back higher and make the move, but that did not occur. So what does the message of the market tell us? It tells us that this is nothing more than a quick little bounce, and the rate of descent is most likely going to continue in play where support should be taken out. This would be an area you would look to be for resistance as it has a decent move below it. The low is 1.98 ounces for this paper rectangle. And that would be the area you'd be looking for resistance. Now, it does look as if the way this is going, that you're going to be able to get these paper rectangles for grains on the troy ounce, basically. As I overall think it's going to zero. I think this is going to literally go to zero, but a decent sized break below is to be expected. Finally, this candle is September 20th. It's basically 3/4 of the way through. So if I was looking at this on a 1 minute time frame, let's assume that this is, I don't know, I'm just looking at some sort of average stock on the 1 minute time frame. This is 2 hours worth of data. Let's assume that this is $40 on the top and this is 39. And then everything in between. I'd be looking at this saying this thing is breaking down. We're going below 39, probably test 38 and change. Will it happen this period? After all, this is 40 seconds or so into the period, 45 seconds into the period. It very much easily could continue that period lower and then follow into the next couple, 3, most likely continuing with the further downside movements. And that will be it for today's video, which is now pretty much 20 minutes long, and I figured it would be. So I'd like to thank you for tuning in, and have yourself a magnificent day. Bye-bye.